right, we got the market right now trading a little bit lower here on the heels of yesterday's record-setting close, which saw the Dow, the Nasdaq, and the S&P all at lifetime highs in tandem for the first time since 1999. So, okay, some people taking some money off the table a little bit as we head into this Friday. You know, here's the question. You got an economy that's clearly struggling. I mean, did you see the producer price index read today suggesting that, you know, really we don't have any inflation in this economy at all? So you get an economy that's just lousy and a market that just keeps powering higher. Why are these two things so divorced from each other? Join me right now, Rhino Trading Partners Chief Strategist Michael Blanc, along with BGC Partners Senior Strategist Steve Cortes. Steve, to you first. I mean, it used to be not too long ago that effectively the stock market was anticipating what the economy would do 6 to 9 months out. So it was a very good barometer for the overall U.S. economy. Where are those days?
Right, Trish. Well, I wish we could have those days back. Unfortunately, we're in an era of central planning and of quantitative easing by central banks globally. And so we're in this bizarre world where bad news can actually fuel the stock market higher. And I think that's what we've seen lately. Most of the economic data, not all, but most, has been pretty poor lately. Terrible GDP report. You mentioned a bad PPI report today. July auto sales were miserable. Retail sales disappoints. And yet the market keeps going to all-time highs. I have to say, though, I do think we're nearing the end of this game where cheap money keeps forcing capital into U.S. stocks. I think that's part of it, too, by the way.
We've been saying that for a while. I'm sorry, Steve. I've been saying that, too. I mean, you just say to yourself, how long can this really and truly go on? And I'll tell you, what was the quote from the city, head of city, who said that, you know, that while the music's still playing, you know,
you have to keep dancing.
You've got to keep dancing, and that's what was going on. Thank you, Chuck Prince. That was what was going on back in '08. And, you know, we're not, I don't think, looking at a crash at any time soon in the horizon. In fact, I'd argue that the music's going to play a little while longer here. What do you say?
Yeah, well, that's just it. You know, we're in this dance, and it's like the end of like a punk rock concert where, you know, you're at the end of like the Ramones concert and you're exhausted and everyone's sort of flailing around the mosh pit and everyone's going on. Nothing's happening here. The VIX is below, you know, at 12 or below 12.
That's, by the way, the measurement of volatility in the overall market. People look at the VIX to see whether or not things are dicey.
There's not a lot happening, and there's not a lot of volume. It's like the end of the night, and everyone's sort of straggling around here. What do we do with this? Now, Mr. Trump
we just keep moving higher.
Yeah, Mr. Trump was just speaking, though, and he talked about a very important problem that could be the beginning of the end. He talked about how wages haven't moved in 18 years. Yeah. Look at that non-farm productivity number earlier this week, down 0.5%. 3 quarters in a row down. That hasn't happened.
So productivity is declining.
Yeah.
Wages haven't budged. GDP is basically nowhere. So what's the future?
Which everyone says, well, the Fed's never going to raise rates again. But look, you know, the jobs data is better. The markets are rallying. They can't say there's global turmoil anymore in the market sense. Markets keep rallying. Now, next week, we're going to get these Fed minutes on Wednesday. On August 26th, Janet Yellen's making a very important speech at a conference in Jackson Hole.
I apologize. We're going to be watching for that. I am out of time. Coming up on a hard break.